What's up, everyone? Welcome to this video. Today we have a very special guest, Angel Ortiz, and he's going to be taking care of you guys. He specializes in loans. So, Angel, if you can just introduce yourself to everyone, that'd be greatly appreciated, boss.
Hey guys, again, my name is Angel Ortiz. I'm a loan officer with Cornerstone Home Lending. We're located nationally, but specifically, I'm in the San Antonio branch. And so I'm a loan officer and have been doing it for about 3 years now.
Yes, sir. Yes, sir. And if you can just tell everyone, what does a loan officer do?
Yeah, so this is a question I get a lot when people, think of the home buying process. A lot of buyers only know what a realtor does. Uh, so it's a good question. A loan officer basically works hand in hand with the realtor, the builder, the buyer, basically anyone involved in the home buying process. They work with specifically the buyer on making sure they can get approved for their home. So unless they're buying the home cash, they're going to need a loan. And so basically, I'm a mortgage loan officer. I help buyers get approved for a mortgage so they can close on their home. Unless they're buying cash, then they don't need a mortgage. And so the way I explain it to people, because not a lot of people have bought, more people have less knowledge on buying a home as opposed to like buying a car or something. You're at the car dealership, you're working with the car salesman, and say you like the car, you have the car you want picked out, you go back and the dealership's starting to get you set up on getting approved for a loan to buy that car. Well, basically, I'm the finance manager of the car dealership. So, in this scenario, the car is the home, the home that you're looking to buy. The car salesman is the realtor, showing you the car, telling you everything about the car. That's what the realtor does for the home. And then I'm the finance manager of the car dealership. So I'm the person that tells you, hey, you're approved for this amount. Here's what your payment would be. Here's what your down payment will be. Here's what your closing costs will be, things like that. And basically, I go into all the financials of what buying this home would look like for the client, and then also making sure they can get approved to buy the home.
Hey, that's awesome. That's awesome. So, the next question is, how can someone pre-qualify for a loan, and uh, what do you guys put into consideration to qualify somebody?
For sure. So this is a good question. I'll give a broad answer, but there's a lot of things that kind of go into buying a home. Um, the first step is applying. So you're going to want to apply with a lender. Um, for me, for instance, with me, I have a website that buyers can apply on. They can come in person and apply. We can apply over the phone. But basically, we're having you fill out an application that probably takes about 15 minutes. We're going to go over your personal info so we can pull credit. We're going to go over your employment for the last 2 years, and your income so we can compare your income to your debts. And then lastly is really just seeing how much money you have saved up. So, just seeing that the buyer has enough money for a down payment, closing costs. If they don't, okay, well, let's start looking into, can you get a gift from a family member? Or can we look into down payment assistance, or maybe some loans that have 0% down, things like that. So when we're looking at an application and seeing what makes someone qualified or not qualified, there's a lot of things, but the the broad answer would be 2 years of employment, and then basically what do you make at that job compared to the debt you have. So, someone who makes 50 grand a year, we're going to take that 50 grand and compare it to their debts that they have, whether it be a car loan, student loans, credit card debt, different things. And we basically have to be at a threshold depending on what loan program we're using. We have to compare those debts to the income to the debt, and be within a threshold for whichever program they're looking at.
Okay, for sure. And what loan are people mostly going towards? Is it FHA or is it conventional?
So I would definitely have to say an FHA loan. FHA loans are more what a first-time home buyer is going to be using. The reason being is they're not as strict on credit score. You can go down to a 580 credit score, where a conventional loan, you have to be at a 620. A USDA loan, you have to be at a 640. So FHA is a little less strict on who they'll lend to. So they'll lend to someone with a 580 credit score. Your debt to income ratio can be higher. So, if you have a little bit more debt, there's a better chance you can get approved for an FHA loan as opposed to conventional USDA, things like that. But that's the loan I would say most people are going with. The other reason being is you can put less down. So a lot of people think, when they're buying a home, okay, I got to put 20% down, 10% down, 5% down. And that's not the case. A lot of times you can put down 3.5% down. It depends on your file as a whole. But for most people, you can get away with doing the 3.5% down for your down payment. So you can get into your home for less money with a little bit more debt and a little bit lower of a credit score. And that's, usually where a lot of first-time home buyers are at. So it's usually a better loan for them.
Hey, that's awesome. So what does someone need to avoid to qualify?
So there's a lot of things that, could go into that question or the answer. I would say the biggest things are, one, take care of your credit. When you're young, I feel like a lot of people don't, being young myself, a lot of people don't tell you what to do with your credit, how to stay out of trouble with your credit, and so that's the first piece, is just keeping that credit, preferably over a 620. Yes, we can do loans as low as a 580, but if you're over 620, that really helps your chances of getting approved. So keep taking care of your credit, taking care of your debt. So, there's people who, right when they get that first job, they're making, decent money, and the first thing they go and buy is a car. Or they start opening up credit cards and running it up and racking up a lot of debt. Well, the more debt you add up, the harder it is for you to buy a home. I'm not saying it's impossible. I've done loans for people that have countless debt, just debt for ages. But the more debt you have, the more income you have to qualify for a home. So my advice would be, if you need that car, or if you want that car, but you're also thinking about buying a home, buy the home first. That way you can have that low debt to income ratio when you're going to buy the home, and you're more qualified. And then once you close on the home, then go buy your car. That way, you can kind of get both. But if you buy the car first, then try to buy a home, it's not impossible to get a home, but it just makes things a little more difficult if you don't have enough income to offset the debt. So really just the credit score, the debt, taking care of your debt, and then changing jobs many times. If you're changing jobs a bunch of times, and going to a job where you're self-employed, it just makes things a little more difficult with getting qualified. So staying at your jobs longer, is definitely going to help your chances of getting qualified.
Okay, awesome. So I have a question. Does it have to be in the same industry, or like if you switch jobs to a different industry, is that what
For sure.
hurts you?
So that's a great question, and I get that question all the time. A lot of people will tell you, oh, no, it has to be in that same industry. Or if you started your job a month ago and it's in a totally different industry, you're not going to be able to get a loan. You have to be in the same industry for 2 years. That's not true. For most cases, that's not true. So, if you're a buyer where you've been working, let's say, a W-2 job, and you work at USAA and you've been there for 2 years, and then a month ago you moved over to working for, let's say, Chase, you're still a W-2 employee. Or let's say it's something different. You go from USAA, which is, financial, banking, insurance, whatever you were doing there, and you move to something like, I'm looking at Discount Tire right now. So if you went to Discount Tire and you were a manager at Discount Tire, that's obviously a completely different industry. You're moving to tire sales and the automotive industry in a way. So, but as long as we can collect 30 days of pay stubs, and you're a W-2 employee and you're either hourly or salary, as long as we have 30 days of pay stubs and you're full time, we can use that income. So you don't have to, be at Discount Tire for 2 years in order to buy that home. I just have to have a 2-year history of working somewhere, And then I have to have 30 days of pay stubs working at a full-time job where you're hourly or salary. If you're commission, bonus, overtime, things like that, that's going to need a history. But if you're hourly or salary and it's a W-2 job, I can do it with just 30 days.
Hey, that sounds awesome. Okay, so I have two last questions for you.
Okay.
How does someone maximize their loan amount?
So to maximize your loan amount, what you're going to want to do is one, you would want to have lower debt or more income. So that's the first thing I can think of is to maximize your loan amount, you're going to want as little debt as possible with as most income as possible. So, someone who makes 200 grand a year, obviously that's a lot of money, but if they have, I've seen people who have $400,000 in student loans. I've seen people who have, two different cars that each have over $1,000 payments. So that person that makes 200 grand, that's a lot of money. They may not be able to get approved for someone or for as much as someone who makes 80 grand and has no debt. So you really want to keep your debt low and your income maximized as much as possible. And that will increase the amount or your loan amount that you're pre-qualified for. So it really comes down to that is your debt to income ratio for sure.
Okay, cool. And the last question is, how can someone minimize their monthly mortgage payment?
So a few things come to mind when you're wanting to minimize your mortgage payment. One is when you're going to buy your home, the lender is going to call you to lock in your interest rate. So when they go to lock in your interest rate, they're going to look at a few things. They're going to look at credit score, your debt to income ratio, what type of loan you're getting, how much you're putting down, things like that. And what type of home you're buying, whether it's an investment home, second home, a primary home. And so when you lock in that interest rate to minimize your payment, you're going to want the lowest rate possible. So, if someone with a 2.5% interest rate will have a significantly lower monthly payment compared to someone who has a 5% interest rate. So, and how you get the lowest interest rate is one, taking care of your credit. Like I was saying, a better credit score will result in a better interest rate, which results in a better mortgage payment. And then also working with a good lender, that's going to take care of you on that interest rate. Lenders for the most part are kind of, all around the same interest rate. There are lenders that have better interest rates. There's lenders that have way higher interest rates, things like that. So you're going to want to secure a good interest rate. The other thing you can do is put more money down. So, if you do have that 5% down, 10% down, 20% down, the more you put down, the lower your monthly payment will be, of course. So, more money is going towards the purchase. So your loan amount is less, you're borrowing less, so your monthly payment will be less. The other thing is, real quick, is whenever you put over 20% down on a conventional loan, you have something called private mortgage insurance that you do not pay. And, this is kind of roughly speaking, but PMI, private mortgage insurance, would be roughly anywhere from 75 to I've seen as high as $250, $300 a month. If you put 20% down, you don't have to pay that monthly. So that's another way to get those that monthly payment down is by putting 20% down or more. We have other options, and I can kind of go in more on this as much as we need to, but we can buy out PMI. So even if you're going to do 5% down, there's a way where we can buy out the MI to where they pay a one-time fee at closing to where they don't have to pay it over the loan month over month over month. So, for someone, for instance, I had a client, he wanted to do 5% down, but he didn't want PMI. So I was like, okay, no worries. Let's do 5% down. And basically we did what's called a PMI buyout. So he bought out his PMI at closing. He paid, I believe, somewhere around $3,000 at closing instead of paying $150 per month for the next, number of years. So it's a way to get your monthly payment down. You do pay more at closing, but it's a way to get your monthly payment down. There's also loans like a VA loan. So if you're a veteran, or if you're active duty in the military, you can qualify for what's called a VA loan. And they do not have private mortgage insurance at all. So that's another way. If you're a veteran, your payment's going to be less than someone like me who's not a veteran or not active duty. Your mortgage payment will be less. So there's just different ways. That's a little bit in a nutshell. But yeah, there's a lot of other ways too that, if I'm working with a client, we can dive into each scenario and see what would be the best route for them.
Hey, that's insane. I didn't know you guys can do buyouts like that. Is it always 3,000 or do the prices range?
So good question. The prices range. So it's not always going to be a clear cut, hey, this is how much it costs. So what they base how much it costs for a buyout based off the same things: your credit, your debt to income ratio, what type of loan, or it's only a conventional loan. So your conventional loan and how much you're putting down. So someone with a 700 credit score, 5% down, and a low DTI will be paying one amount, but someone with a 780 credit score, 5% down, and a even lower DTI will be paying a different amount. So it ranges off of basically the risk the lender's taking on you. So if you have a higher credit score, a lower DTI, and a bigger down payment, that buyout will be smaller. If you have basically, if you're the opposite of that, if you have a lower credit score, a lower down payment, and a higher DTI, then the PMI will be a larger amount.
Okay, that makes sense. So I know FHA, they have MIP. So I believe you're stuck paying MIP throughout the entire loan, right? Or am I mistaken?
Exactly. So on an FHA loan, they charge a mortgage insurance premium. So at closing, you're paying a fee charged by FHA. And basically it's something that's rolled into the loan amount. So, say your loan amount is 200,000. Well, the mortgage insurance premium will be an additional fee that is also rolled into that loan amount. So you pay a fee at closing. It's rolled into the loan, but it is something charged at closing. And then you pay the MIP or the PMI, private mortgage insurance. You pay it every month until you sell the home or until your loan is over those 30 years. Or however long your loan is for. So that's a perk of going conventional opposed to FHA, is that PMI will be there forever on an FHA loan. So whether it's $150 or $200, you're going to pay that every month as part of your mortgage payment for the entirety of the loan. But on a conventional loan, if you do the 20% down, you don't have the PMI. And then say you do 5% down and then you stay in the home and you make more and more and more and more payments. Whenever you attain the 20% equity in your home, the PMI drops off on a conventional loan too. So that's just a little perk of going conventional as opposed to FHA is you will have that PMI drop off at some point. FHA, you'll have it for the entirety of the loan unless you refinance to a conventional loan at some point.
Hey, I did not know that, bro. I really appreciate you. Before we actually wrap this up, do you have any advice for people who are looking to get into a home right now?
My advice would be kind of what I talked about at the beginning. Take care of your credit, minimize your debt as much as possible, stay at your jobs. So, try your best not to job hop and, move to self-employed jobs or no job at all. Just try to be doing something. And if you find that good career job, where you think you're making decent money, go ahead and give me and Tylen a call so we can run through a pre-qualification. It's not a lot of people chop up the home buying process to be very scary. And it can be if you're working with the wrong people. If you have the right people guiding you and, hey, do this, do that, it can be a very streamlined and easy process if you're working with the right people. So, credit, minimize your debt, stay at your jobs, And then lastly, I would say just try to save up money. So, you know, if you can, even a few $1,000s, that definitely goes a long way in buying a home. But yeah, just try to save all the money you can so that you can maximize how much you can qualify for. That would really be my advice for anyone that hasn't bought a home yet. You know, and like I said, if they need any more questions, or if anyone has needs more clarity, I'm more than happy to kind of dive into it and run a pre-qualification for them and let them know, hey, you're good to go right now, or hey, we need to do X, Y, and Z to get you ready. You know, and whether that'll take 2 months, 3 months, 6 months, let's get you on a game plan to home ownership. And so that would be my advice.
All right, awesome, bro. I appreciate that. And how can people contact you?
So I can give, I'm sure somehow in this video we can drop, you know, my contact info. But you can reach me through Facebook, Instagram. My phone number is 210-445-0439. And then my email is real simple. It's just aortiz@houseloan.com. I'm sure we can drop it somewhere in the video. But those are the ways you can contact me electronically. If you want to come in, my office is here in San Antonio. I'm right by the rim. In between 1604 and I-10 and 1604 and 281. So kind of located kind of, you know, around a lot of things. So, you know, people can come in person and talk, or if they want to just call me, text me, email me, I'm more than happy to help.
All right, awesome. Well, Angel Ortiz, it was a pleasure to have you on this Zoom call, bro. I appreciate all the knowledge that you dropped, all the wisdom. Shoot, I even got some value. I didn't know about 80% of the stuff that you were saying. So I really appreciate you. And for everyone watching this video, we're gonna go ahead and see you guys on the next video. I appreciate y'all.
Cool. Sounds good.